Imagine doing everything right. You work hard for over 30 years, hit your retirement goal, collect your very last paycheck, and finally step into your freedom. But then, out of nowhere, an invisible retirement risk quietly unfolding in the background. Over time, it slowly begins erasing the lifestyle you spent decades building, threatening to pull you back into the workforce before your first decade of retirement is even over yet. Most people never imagined that could happen, because for decades, the financial industry has repeated the exact same comforting line. If the market averages 8 to 10% a year, and you only withdraw a conservative 5 or 6%, your life savings will last forever. It sounds ironclad, and it feels logical. And as a fact, most people never doubt about it. And unfortunately, this idea is dangerously misleading, because your retirement doesn't actually care about average returns. It obeys sequence. And if the better returns arrive at the worst possible time, two portfolios with the same starting balance and the same average lifetime return can end in completely opposite realities, one leaving you incredibly wealth, and the other leaving you entirely broke. And that's exactly why retirement risk becomes so much bigger than just investment returns. Because at this stage of your life, retirement is no longer just math. It's about your independence, your peace of mind, and the freedom of knowing you will never become financially dependent on your children later in life. My name is Amber, and in this video, I'm going to show you how sequence of return risk quietly destroys retirement plans and the simple architecture you can use to protect your lifestyle. Let's start with the dream scenario first, the happy path. You retired with a $1 million portfolio and started to take out $60,000 a year to live your life. Yes, the market still crashes sometimes. That's normal, because strong returns happen earlier in your retirement. The portfolio absorbed the declines and kept compounding. And 20 years later, you still have more than $2 million left. That is the retirement freedom most people spend decades working towards. But the retirement comes with one reality we cannot control. That is, you don't get to choose the market you retire into. And what if retirement begins right before a major downturn instead? Remember year 2022? Now, let's change only one thing. Let's swap the market return between 2022 and 2003. Instead of the market decline happening later in retirement, we move that same loss to the very beginning. Everything else stays identical. Same starting portfolio, same withdrawals, same long-term average returns. But now, look what happens. The portfolio runs out of money in just 17 years. And here is the terrifying reality. We are still alive, and we still need income. This is the moment retirement stops feeling secure, and the questions suddenly become painfully real. Do I need to cut my lifestyle? Do I have to go back to work at 75 years old? Am I going to become financially dependent on my children? This is the devastation of a sequence of return risk. Earlier losses combined with ongoing withdrawals can permanently weaken the portfolio's ability to recover. Even the market made new highs later, you are left behind. The good news is, sequence of return risk is not a permanent threat throughout retirement. The danger is heavily concentrated near the beginning. Think of it this way. A major market crash in year 20 usually doesn't destroy retirement. Why? Because your money already enjoyed decades of compounding growth. You have built a financial fortress. But a crash in year 1 is completely different. Withdrawals begin immediately while the portfolio is already damaged. That permanently weakens the compounding engine before recovery even has time to get started. And that's why retirement resilience matters so much. We cannot control what we are marked to do when our retirement begins, but we can build a structure designed to limit the damage of an earlier market crash. Unfortunately, this is where many investors fall into one of the most comforting assumptions in investing: the belief that as long as the market eventually recovers, my retirement portfolio will be just fine. And it makes total sense on the surface. Historically, the market always comes back. The market survived the dot-com crash, the 2008 financial crisis, the COVID panic, and the brutal 2022 bear market. No matter how devastating the downturn looked in the moment, the market always found a way to bounce back and make new highs. And ironically, that history of recovery is exactly what makes this trap so dangerous. Because over time, investors became conditioned to believe recovery alone was enough, just like it had always been during their working years. So naturally, many people assume as long as I stay invested, everything will eventually recover. But retirement changes the game rule entirely. Think about how you build your wealth during your working years. A market crash is actually your friend. The market fell, but your paycheck was still coming in. You kept contributing to your retirement accounts. And you still have a massive recovery runway ahead of you. Time repaired the damage because you never needed to touch your principal. In fact, downturns often helped you accumulate even more shares where prices were lower, strengthening your future recovery power. But the day you retire, the runway disappears. A market decline by itself is already very painful, but combined with mandatory income withdrawals, that is where permanent structural damage begins. Your portfolio is now bleeding from two directions at the exact same time. The market is pulling your assets values down, while you are forced to withdraw cash just to pay your bills. To get that cash, you have to sell your investments at the possible worst time, maybe the bottom of the market. Once those shares are liquidated, they are gone forever. They cannot participate in the future rebound. The double bleed permanently destroys your portfolio's recovery power, leaving you with a hollowed-out nest egg, even after the market made a full recovery. Once recovery power is weakened, the math becomes far more unforgiving than most people realize. This is what I call the break-even illusion. If your portfolio drops 10%, it takes 11 to get back to even. If the market takes a brutal 30% hit, you will need a massive 43% rally just to crawl back to your starting point. Now, factor in your active retirement withdrawals. If you are pulling 6% income out while the market is already 30% down. So your retirement break-even hurdle skyrockets past 50%. Suddenly, the portfolio isn't just trying to recover, it's trying to refill a bucket that's still leaking. And for retirees already in their 60s and 70s, there simply isn't enough time left on the clock for a miracle recovery like that to happen. That's how earlier losses combined with ongoing withdrawals can quietly reshape your retirement lifestyle long before you realize the damage. What makes this so destructive is something called reverse dollar cost averaging. During your working years, market dips helped you buy more shares at lower prices. But retirement flips the entire process upside down. Instead of buying the dip, you are forced to sell more shares at lower prices just to generate the same income. And once those shares are sold, they can never participate in the future rebound. That's how the double bleed quietly drains the portfolio's future recovery power. Now, you might be thinking, okay, I understand the math now. So the solution must be portfolio diversification. Diversification absolutely helps reduce volatility. But here is the brutal reality. Diversification alone cannot fix the sequence of return risk. During the 2008 financial crisis, the S&P 500 collapsed by roughly 37%. A classic diversified 60-40 portfolio still lasts more than 20%. That may sound better on paper, but if retirement has already started and withdrawals are already happening, the double bleed is already active. The portfolio is still shrinking while withdrawals continue, and recovery power is still being permanently weakened. And this is the critical shift that most retirees never realize. Sequence of return risk is not an investment problem that you can simply asset allocate away. It's an investment architecture problem. Because once retirement begins, the problem is fundamentally changed. The real question becomes, how do I prevent the temporary market crash from permanently damaging my lifestyle? Now, at this point, you might be thinking, okay, Amber, I see the danger of the double bleed. If the market downturn happens earlier in my retirement, I will just cut my spending for a while, wait for the market to come back. And to be honest, that sounds very reasonable until reality of your retirement actually kicks in. Because when people look closely at their real retirement expenses, they discover something uncomfortable. Most of their spending isn't optional. You can cancel a trip to Hawaii, but you can't cancel your property taxes. You can eat at home, but you can't stop paying for Medicare, homeowners insurance, utilities. And in the background, inflation quietly keeps pushing all of them higher. Your essential bills do not care how the heck the market is doing. They demand to be paid, which means the portfolio is still being forced to sell assets at depressed prices right through the middle of the market downturns. And that drags retirees back into the exact same reverse dollar cost averaging cycle we discussed before. But once you understand where the damage came from, the solution becomes much clearer. Because ultimately, the goal of retirement planning is not avoiding every market downturn. Volatility is a part of the market, and it always will be. The real goal is resilience, is to build enough stability, enough flexibility, and enough protected income So temporary market drops never become permanent financial damage. Because once your structure can survive the storms, time regains the ability to heal, to recover, and to compound again. Earlier, we saw this exact portfolio collapse after 17 years. But now, let's change just one thing. What if your retirement income doesn't need to come from your portfolio during those first difficult market years? In this example, all we did was use an alternative income source to cover your expenses for just 24 months. That's it. No complicated forecasting, no magical returns. Just enough structural flexibility to avoid forcing asset sales during that earlier decline. And look at what happens. The double bleed is completely neutralized. Your recovery is preserved instead of collapsing. The portfolio finishes with over 1 million still remaining. Psychologically, that totally changes the retirement experience. Volatility stops feeling like a threat to your lifestyle and simply becomes something your portfolio is built to live through. So, how do we actually build flexibility into retirement? We stop forcing our life's savings to carry all the pressure, demanding that it grows aggressively while simultaneously protects our lifestyle through a downturn. Instead, we separate responsibilities intentionally. So, we give different assets different jobs. One portion becomes the income cushion. Its only job to provide stability. Income cushion can come from cash reserves, Social Security, rental income, or any other structured cash flow that is isolated from daily market swings. These income streams can help cover your expenses while the market is acting out. That creates massive breathing room for your portfolio, which allows the second portion, the growth engine, to do its real job, compound long-term without interruption. Because when growth assets are no longer forced to fund living expenses during market downturns, they regain time. And time is what compounding needs most. The exact balance between income cushion and growth engine looks very different for everyone. But intentionally separating stability from growth is how resilient retirement structures are built. Traditional retirement planning is almost always presented as a game of chasing higher investment returns. But the moment retirement begins, the game changes. It stops being just about growing a bigger number on a screen. You want confidence, you want flexibility, you want the freedom to enjoy your life without constantly worrying when is the next market crash and what it might do to my future. Because as we have seen today, the real danger in retirement isn't just the market drop itself. It's what that drop forces you to do financially and emotionally. True retirement resilience isn't about predicting storms. It's about building a structure strong enough to survive them. If you are approaching retirement or already retired, ask yourself, where would your cash flow come from if markets declined next year? How dependent is your lifestyle on continuous portfolio withdrawals? And which assets are actually designed to create stable income? If you would like a second set of eyes to stress test your current structure, there is a link below where you can request a complimentary retirement resilience assessment. Thank you so much for watching, and I will see you in the next video.